Tortoises, not investing due to fears of a recession is one of the worst mistakes I see people make. They typically say, "Oh, I see things going downhill. The inflation is going through the roof." No, tortoises, not investing because of a recession is one of the no. Tortoises, not investing due to fears of a coming recession is one of the worst mistakes I see people make. I see so many people saying stuff like, "Oh my God, inflation is through the roof. Wars, there is war everywhere. I mean, look at prices. Look at this oil crisis. Look at this and that. Look at interest rates, right? Look at the clashes between the United States and China." And so the chances are there will be a recession. So I will wait for it to pass and then I will invest. This is so wrong. And in the words of Peter Lynch, one of the best investors of all time, by far more money has been lost trying to predict recessions than in the recessions themselves. So in this video, I'm going to tell you exactly why not only I'm preparing myself and the people that I'm coaching to embrace the next recession, but we will also be more aggressive when that recession comes, because that is the time when you should be greedy. Remember, you should be greedy when others are fearful and fearful when others are greedy. Now, granted, if you are just watching this for the first time, number one, welcome. And if you are not, thank you so much for being a dear subscriber. But if you are watching this for the first time and you don't yet have a framework, then just go back to some of my previous videos. Go to the link in the description and download the 4M framework that comes with a special surprise for you. But essentially, this will make you a lot more prepared for what's coming, because it will definitely fast track your investing knowledge, your investment knowledge, as far as the stock market is concerned. Now, let's talk about the main topic of today's video. And many of you are already familiar with this chart right here that I'm about to show you right now. I'm sharing my screen as I typically do. And this is just to give you an example of the S&P, which is an index most of you are familiar with. And you can see that going back to 1930 all the way through 2019, you can see that the S&P had quite lengthy periods where the market didn't do anything. It stayed flat for over decades, which is astounding if you ask me. Take a look at this. This period, 25 years to break even, but you can see how the market, just after a crash, comes back, retests that previous all-time high, and then goes up. This coincides with the strong bull market, and then you have periods of consolidation. Then we have another bull market. Then we have another period of consolidation and some downward pressure, and then we have another bull market. And rightly so, this has been one of the most lengthy bull markets in history. In fact, no, let me rephrase that. It's been the longest bull market in history that started right after the global financial crisis in 2008, and with the exception of the dip that we saw during COVID, but it was just months old, because the market went down about 40%, and 2 months later it was already making new all-time highs. That is not a significant recession. So the last time we had a big recession was back in 2008, when the global financial system was literally melting down. So will there be a recession? The answer is absolutely yes. But the point of Peter Lynch's quote initially is that you guys, you cannot predict when the next recession will happen. In fact, so many people were predicting the Federal Reserve in the United States to increase interest rates like during the past Fed meeting. And what did they say? They were expecting them to start lowering interest rates from now onwards, now that the war between China and Iran came to an end. What did they say? They said, listen, inflation is still high, so we will actually have no problem increasing interest rates if these inflationary pressures were to persist. That completely caught so many macro and economic experts off guard. This is the point, guys. if people at the Federal Reserve themselves cannot agree in terms of what will happen to interest rates, what makes you think that we investors can? And the point here is that we cannot predict the future, but we can definitely control a few things. Number one, we can control the quality of the companies that we buy. And number two, we can control the prices that we pay for those great companies. And if you buy a great company at the wrong price, then you have to be concerned about the company itself and also about macro stuff. Yeah, because you probably bought at too high a price that was already pricing in too much optimism, and that is not what we do at Like a Tortoise. And so, sorry about that, but it's really really hot today in London. I'm recording this on June the 24th, and man, it's just 30, almost 35 degrees right here. So I mean, you can see in my face that I'm feeling the heat, but right, so this is the point. As always, I put together a PDF that I want you guys to walk, that I would like to walk you through. I will keep this video short and sweet, so that you guys can. But I will make the most important point understandable, so that you guys can understand exactly where I'm coming from. Let's open our video right here. So this is our video. So should you invest during a recession? And why am I asking this? I was having a conversation with a potential client the other day, and she was explaining to me that she was very skeptical of the economy, right? Because whenever she goes shopping, she sees the prices, she talks to other people that are struggling, and we all see that, in all fairness. So this is not me picking on her. But the thing here, what I always advocate for is, let's focus on what we can control. So should we invest during a recession? This is it. When markets are falling, guys, headlines are definitely negative. Look, we all know that, and it's going to be nasty. Go back to 2008. Go back to 2000, to the pandemic crisis. So many people were calling for the end of the world, and it's very hard for us to be emotionally resilient and capable of pulling the trigger, even if we are talking about great companies. But when markets are falling, headlines are negative, and fear is everywhere. Most investors feel the urge to do nothing, or worse, sell. Yet, history shows that some of the best long term opportunities have appeared during periods of economic uncertainty. So, going back to Peter Lynch again, he's one of the best investors of all time that was managed to compound money at 29.9% over a 15-year period. And he says that. And throughout this tenure, he experienced many drawdowns and crashes, and he never stopped investing. Again, the point here is that he understood what he was buying, and number one, he had a decent understanding in terms of the value, a decent understanding of the value of the companies. If you don't know any of that, then you absolutely shouldn't invest. Take a step back, invest in your education first, and once you build that knowledge, then you will start putting some of your hard-earned money to work. What most investors do, many investors panic during downturns. They watch their portfolios decline, consume negative news all the time. Think about some of the individual companies that we own. Full transparency, we own a company like PayPal or Lululemon, both of which have been plagued by negative headlines almost on a daily basis. It was the same thing that was happening to Alibaba when the stock was trading at $54 a share, and the big banks were actually downgrading the stock. You cannot make this stuff up. And then the stock went up to 190, and all the major banks like Goldman Sachs and JP Morgan and Wells Fargo started revising their intrinsic value upwards. It's just natural human behavior. So we have to fight against the crowd. They watch their portfolios decline, consume negative news, and pull money out of the market precisely when prices are becoming more attractive. If the price of a great asset is coming down, shouldn't you guys feel excited about it? Unless you are buying some rubbish company that is sitting on a lot of debt, and with a very poor track records, and poor management team, why are you worried so much? Right? So lower prices should actually excite you, because you will be buying more of that company at lower prices. And then what will happen is, once the market reprices back that company to its real value, you're going to make a ton of money. And this is what the best investors in the world, from Peter Lynch, from Phil Town at Rule Number One, from Warren Buffett, from Charlie Munger, have always done. And guys, they have done this for decades. So I'm in my 30s. I've been doing this for a few years, not decades. But these guys have done this for several decades, and they know it. They know very well how recessions are phenomenal if you are like a tortoise type of investor, an investor that is long-term quality oriented. The problem with waiting, the economy and the stock market are not the same thing. By the time the news improves, markets have often already recovered. Waiting for certainty can mean missing a significant portion of future returns. This is it. So many people, again, I'm not picking on individual people, but for example, just to give you one as an example, and I've listened to many of his podcasts, but let's take Peter Schiff as an example. Peter Schiff has been calling for a recession for 50, 60 years, for 15, 16 years. Now, if you had followed his advice 15, 16 years ago, you would have monstrously underperformed the overall market. So there are times when we should be more pessimistic than others. But the point here is that if you overemphasize the macro landscape, I think that you're gonna lose. You're gonna lose. So instead, start looking at where value still is, even in a very expensive market like we are facing right now. You can still find several pockets of the market that are priced very attractively, and those are the same pockets that should draw your attention. So pay attention and don't read too much into this news. Uh, Keep investing during downturns. This is important. Dollar cost average instead of trying to time the market. If you believe that individual stock picking is not for you, and most people shouldn't be doing individual stock picking because they don't want to pay attention to their portfolios, even if it's only 1 hour per week. And so, what they should be doing, in my opinion, is just put their money in a low cost index fund. Now, look, there will be periods of time, this is important, where you may see no returns for a decade. And you have to be comfortable with that. It's much harder to digest that if you are already in your 40s or 50s. Can you imagine some of the people that I'm coaching if I told them that, look, you will see flat returns over the next 10 years? No, that is not the point of stock picking, which is what we do here. The point is, even in those periods of flat overall markets, you make a lot of money. Those are some of the times when Warren Buffett built the vast majority of his wealth during flat markets, because underneath the surface, several of those companies will perform very well. But it's the market as a whole that struggles. But if you don't want to pay attention to your portfolio, not even 1 hour per week, and I assume all of you guys are okay with that, otherwise you wouldn't be watching this channel. So that means you want to pick stocks. But if you are in that camp, then just place your money in a low cost index fund, and don't look at it over the next 20, 30 years. Chances are you will get your 9% annualized returns. Okay. So dollar cost average is important, even though we do it differently at Like a Tortoise. I will explain that. And then again, ignore sensational headlines and focus on long-term fundamentals. Even though I studied psychology, as I already made it clear here on the channel, but and I always try to drill down into the minds of the people that I coach the importance of remaining emotional resilient. But it's so hard to do without some level of experience. And even after I teach them the framework, then the ongoing accountability is essential, because they will still pay too much attention to the news that are short term oriented. I mean, it's just inevitable, and it comes with experience. The more you do this stuff, the more resilient you will become, and I think that will only bode well for your future investment decisions. View recessions as potential opportunities rather than reasons to panic. So, final thought, recessions are uncomfortable, but investing success rarely comes from doing what feels comfortable. For long term investors like us, the periods that feel the worst often create the foundations for future wealth. Let me show you another great image that I saw right here, because don't forget that, guys, not every company will behave the same way during recessions, which is why at Like a Tortoise we like to invest in companies that pay dividends and other ones that are just growth stocks. The reason for that is, take a look at this. I have another great screenshot right here for you. Where is that? Is it? No, it's actually here, dividends and buybacks. Take a look at this. You can see that growth stocks, this is Vanguard ETF versus dividend aristocrats. What you can see, guys, is that throughout history, during periods of major declines, dividend paying companies tend to decline less than companies that are solely growth focused. Now, why is that? Because when companies that pay, if they pay you a dividend, they will continue to pay you a dividend regardless of what the market is doing. Whether the stocks, whether the price is going up or down, you will get your dividend payment at the end of the quarter. Whereas a growth company, right, all the money that you may make in that company is solely based on future capital appreciation. And so, what do you think investors are more likely to pile into during a recession? Dividend companies or growth companies? There is your answer, right? And in addition, if they're going to sell the dividend companies, they're gonna automatically they're going to say, well, they're going to stop that dividend payment from coming in at the end of every quarter. And of course, they don't want that. So they are less likely to sell these companies. So you can have a blend of some of these stocks in your portfolio to be better protected against volatility. But once again, the best protection that you can have is knowledge. The better you understand your companies, the better off you will be, the more comfortable you will be holding on to them when things go south. Okay? So, guys, I hope this makes sense. And once again, I'm not calling out any particular person here. Everything I'm doing right here is for educational reasons as well. So I want you guys to learn from my experience and a lot of my mistakes in the past, and I share with you things that I'm seeing with some clients of mine, and because I want you to take that and to use that to build resilience and to make better investment decisions. Okay, so in the next recession, because it will happen, we just don't know when, what I will be doing is I will be buying more of some of companies that I already own, or I will be selling some of the companies that I already own, because there will be even better opportunities, and we have to account for the opportunity cost as well, right? So the setup, those are the great times for us to plant the seeds so that we can harvest the crops down the line. Rinse and repeat like a tortoise. Thank you, guys. Let me know in the comments below if you like this video. Thank you so much. I'll talk to you tomorrow.